First of all, I'd like to thank you, Neck and Neck, for having us here to present our proposal for you for growth into the future. So let's get started. Our expansion and investment analysis for Neck and Neck is presented to you by myself, Tyler, Derek, Massimo, Rolf, and Ryan. Your current reality. Your business is a fashion retail business for babywear and infants. Some of the keys to your success are marketing. The perceived brand quality of Neck and Neck, because it's made in Spain, is very high. And you can utilize this moving into other markets and moving into other countries and regions. Also, it's clear that Neck and Neck has a high marketing understanding. Moving from a cost-plus method to a customer's willingness to pay method, where you're utilizing all the value that your market and product give, is a very intuitive and advanced approach. And we really are glad to see that marketing has been very important to the success of Neck and Neck, because with that market you can grow further. It's also very interesting with Club Neck that Neck and Neck can receive information from its clients and use that information to grow further. Also interesting is its adapting of information technology into the supply chain in all levels and making a more advanced and more progressive approach to doing their business. Another interesting part is the mix of company ownership and the franchise model. This is diversifying the risk of the company and helping it grow in a balanced way. The question is to franchise or not to franchise in the future, and this growth opportunity that we would like to offer to Neck and Neck. We started off by doing some assumptions with the figures we were given. If you look at the income statement for a co-owned or a company-owned versus a franchise, the sales are pretty much the same. However, Neck and Neck will assume under a company-owned rent and salaries. And under the franchise-owned, they will have the related sales of the products that the franchise sells on behalf of Neck and Neck, and royalties of 2%, plus the entry fee. So basically the gross margin for a co-owned is $175,000 versus a franchise of $110,000. On the balance sheet side, there's a fixed asset investment of $120,000 for a company-owned and $95,000 for a franchise. The current reality of the market is very, very intense in rivalry. There are a lot of players in this market. There are barriers to entry, barriers to exit, bargaining power of suppliers, bargaining power of customers, and substitutes. Many people in Spain, when they look to invest in their family, as you well know, they invest in their children. That's a way of showing their wealth and success in life. Overall, this business looks very unattractive, mature with a fierce competition, and there's consolidation in process. The market right now is tightening up. And this is going to be a challenge for Neck and Neck, because the ideal way is to building up and building out into new markets. If you look at a Eurosource market analysis that we put together, and you look at the top right corner, you could see that Spain has a very large market. However, it's quite mature, and it's looking to be quite mature in the future. However, if you look at the bottom row, you could see that Latin America has a lot of growth potential, and it fits with many of the market strategies that Neck and Neck is using in Spain, considering similar characteristics of the demographics of the people, the way that they make business decisions, and the way that they make personal decisions in buying clothes and for their children, investing in their children to demonstrate their wealth and success, we think is key. Therefore, we think that's where you need to be. The drivers of expansion are demographic growth, GDP per capita, emerging social class, a show-off attitude, if I may, It's still fragmented in the market too, which is open for opportunity for a large organized business to come in and have some development there. The keen Spanish lifestyle and cultural values that exist in Latin America are also very important. And we would like to take this aggressive growth potential to 400 stores by 2012. And we think we can do that. And we think we can do that in Latin America, Chile, Argentina, and Brazil, and sections of North America in southern cities like Miami, Orlando, and Los Angeles that still retain some of their Spanish roots, as well as their Latin American new immigrants moving in there have also made a key opportunity as well in this market for us to move into a very important market, as we've previously discussed. The question is, how will we get there? And that's going to require money. The current scenario is a 5-year investment period, store growth at 5.3%, and sector contraction at 3%. This is Spain, and with 58 new stores with the same breakout in this growth, and the same growth, and the breakout of a 40-60 franchise to company owned, we will have 33 owned, 55 franchised, to a total of 268. That would be a $400 million investment. And you probably won't need too much strength from outside to make this investment. The NPV firm value in the 5 years will be $6 million discounted at 13% and an IRR of 35%. However, as we suggested before, we think that a growth case scenario is the ideal way. Therefore, the current scenario is not an option, considering the strength and aggressive market that we're dealing with and the contraction in the market that's happening in Spain. Therefore, the growth case scenario is going to be 16.25% moving abroad and a total of 400 stores. This will be a $13 million investment needed. The NPV of the firm will be $15 million discounted at 13% and an IRR of 50%. What's in it for you, you might be asking. And again, we come back to the money. Money isn't everything, but money is important, especially in these times when people are facing such struggling times as they are today with the contraction of the global market. And, we see some problems in the banking sector, and we think that it's going to be a difficult time to get money. What we want out of this is an equity stake. We would only want to take 25%, and I think that's pretty reasonable. Usually our standard contract terms are that we need to have board permission for there to be the sale of shares, getting any new investors, a merger or sale of the company, purchase, sale of major assets, movement of human capital, things like that. We would also like to see a non-compete clause. We would also like to have convertible preferred shares and a mandatory redemption right, so that we make sure that our investment is secure and you guys are serious about letting us be a part of your business. Now, you might be wondering, why would you want to do this? Why would you want to lose control of your business? But I ask you the question, did you ever have control? The real answer is no. It's up to the customer to buy these goods. And the market has been very successful lately because generally the global economy has been successful. And we think Neck and Neck has done a great job to take advantage of their great brand and the great success in Spain. However, in a changing world, you're going to face fierce competition in the world, low credit, and not a better offer. This could be a very difficult situation going forward as the market contracts. You're going to need trusted advisors. You're going to need someone who can stand by you and support you and have the right contacts and the right capital to make this investment work for you. You need an investor, an experienced guide with all the right friends and experience to help you guarantee your family's future, not just the ones in this room, but their children's children. Thank you very much for your time.